Welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is March 13th, 2022. It is 7:04 p.m. on a Sunday. Today's episode is titled, This Time is Not Different. And here's why. So I remember in 2008, we had the housing market that had a multi-year bubble burst. Same year we had a stock market that had a multi-year bubble burst. The one market that was a little bit different from then to now is the bond market. At that point, interest rates were higher than where they are right now, and inflation was lower than where it is right now. Now, we haven't had the real estate market bubble bursting yet, but at the rate that house prices are increasing, it's only a matter of time. The market can't keep running like that. This time around, we already have the S&P 500 and by a larger extent the US equities market in a bear market, peaking sometime last year into early this year. You also have bonds in the bear market selling off as the Federal Reserve is signaling its intent to tighten monetary policy and raise interest rates to deal with the high and rising inflation. Just like before in the commodity space, we saw gold trading around $2,000 an ounce. Oil also made all-time highs that year. We also saw the same behavior in other commodities like the soft commodities. So that summer I was still a commodities broker and we were making money buying just about anything on behalf of our clients. So we were buying oil, we were buying gold, but we're also buying corn, soybeans, and even gasoline. That summer, anything you bought, it was worth more in a couple weeks. But by the fall, most prices on traded assets had collapsed. Which brings me around to this point. All bubbles aren't created equal. When you have a bubble in a primary market like equities or fixed income, so stocks and bonds, even if it's aided by the Fed with low interest rate policy, the only thing that happens is rich people get richer and their borrowing costs come down a little bit. As a secondary benefit, regular people get to borrow at slightly lower interest rates too. And it stimulates more economic activity, which helps make the rich people even richer. Well, when a bubble forms in a secondary market, like the commodities, tertiary markets like real estate, those bubbles have real world effects and it touches Main Street. It affects people when they go to the grocery store. It affects people when they go to the gas pump. It even affects people when they try to buy a home, as the higher commodity prices feed into higher building costs. So just like in 2008, we'll probably see a crescendo in commodity prices. But by the time those markets collapse and the speculative money that left stocks and bonds when those bubbles burst and moved into commodities and real estate eventually inflate and burst those bubbles as well, when that money comes to a halt and sits in cash, you're going to have the core investors in those markets left trying to mitigate the pain of falling prices. That feeds into Main Street and can eventually lead into a recession. It doesn't help that we're seeing weakness out of Asia by way of China, and now weakness out of Europe by way of Vladimir Putin. Add to that weakness out of the US economy from high inflation, and we've got a recipe for another global recession, just like the last time. With that being said, let's move on to the trade book. Last week wasn't a very busy trading week, but it was still fairly active. I initiated 4 trades, and all 4 trades closed out profitably. Doesn't always happen. When it does, I think it's worth mentioning. I had exposure to the SP 500, gold, USO, and blockchain as a rough proxy for Bitcoin, all through ETFs, SPY, GLD, USO, and BLOK. I spent all of last week shorting the S&P 500 while going long gold and long oil. And towards the end of the week, I threw on the blockchain position based on a chart that I was looking at for Bitcoin. With the ETFs, I like to use options, and in particular option spreads, because I feel like I have a little bit more of a handle on the kind of exposure that I'm taking. So I like using put spreads for my shorts and call spreads for my longs. That's why with the S&P 500, I had a couple put spreads, one expiring on Wednesday and the other on Friday. With gold and oil, both had call spreads. Interestingly enough, the call spread on oil expired on Friday. I saw the diamond pattern on, I want to say, Wednesday evening going into Thursday morning. And by early Thursday morning, oil had collapsed. And that particular call spread went from being deep in the money to just out of the money. I watched the spread all through trading on Thursday. It bounced around at the money, kind of poked above the spread, so just into in the money, but really just consolidated at the money all the way through Thursday, overnight into Asia, into Europe, into Friday morning. It was still bouncing around at the open of New York, out of the money. And throughout the day, oil kind of drifted higher, which pushed the price right into the spread at the money. And a couple times into late afternoon, it started poking through the top of the spread into in the money territory. And my partner at a couple points was actually trying to convince me to close out the position. But because USO is not as liquid an ETF as, say, SPY or GLD, the pricing that I got on the entry really was above where I would normally wanted to pay for that kind of exposure. So that being said, I was a little bit intent on holding on to the position versus salvaging part of the value of the spread with, at that point, would have been a small profit, but a profit nonetheless. But sometimes it just works out that way. Late in the afternoon, we got a small push higher in the price of oil. It took the price through the spread and the money, and was able to close out right before the close of market at, let's just call it, 96% of the full potential that the spread could have captured. Now let's move on to the dashboard. So with the instruments that I track on the dashboard, I look at the price, candle patterns, but I also have 4 indicators that I use to help me interpret what the price has been doing. The first indicator I use is a linear regression curve ribbon. So I took the linear regression curve of the highs of the price, and I took the linear regression curve of the lows of the price, and that ribbon gives me an idea of the price dispersion, which is just another measure of volatility, intra-week, intraday volatility. I also use the Parabolic Sar. That indicator also factors in volatility, and I interpret that as support and resistance. So as that oscillates around the price, if it's above, it's resistance. If it's below, it's support. Then I have 2 linear regression slopes. The short term I use as a proxy for the momentum. So if the short-term linear regression slope is positive, momentum is accelerating. If it's negative, it's decelerating. Same thing with the longer-term linear regression slope. The longer-term time frame is a proxy for the trend. And as with the momentum, when the indicator is positive, trend is accelerating, and vice versa. When it's negative, it's decelerating. In the case of the 10-year Treasury, I've got 2 indicators, the Parabolic Sar and the linear regression curve ribbon, both indicating a downward trend in price. Meanwhile, the linear regression slopes tracking trend and momentum are both negative, but getting less negative. So overall, 10-year Treasury, the indicators are pointing to a continued move lower for the price, but a deceleration in that downward trend. Next up is the S&P 500. Same 4 indicators, different picture. Looking back 5 days, in the case of the S&P, the market has been effectively trading flat. All the indicators are oscillating sideways. The price is oscillating sideways. No clear sense of direction. For those of you that use option strategies that can capitalize on a range-bound market, this would be a good time to deploy those strategies. Iron condors come to mind. But for the trend following strategies, this is something that you're going to want to sit out of until there's a clear breakout in one direction or the other. Next up on the dashboard is crude oil. And despite all of the news coverage of crude rallying higher and war in Europe with the Russian invasion of Ukraine and sanctions and OPEC not delivering on production increases, for all the news that's been circulating about oil over the last 5 days, my 4 indicators are pointing to a slowdown in the acceleration of oil's move higher at best, and at worst, a consolidating pattern that can transition into a reversal pattern. So for instance, my linear regression curve ribbon started the week trending higher. Midweek, we saw a sharp downturn, which came right on the heels of a diamond pattern for those technical analysts that follow chart patterns, which typically, by the way, signal reversals. and is also a very rare pattern, doesn't appear very often. Personally, in my 11 plus years of technical analysis, I've only seen it. This would be the fourth time. But diamond pattern indicated a reversal. Next couple of trading sessions, all was down a lot. The second half of the week, the regression curve ribbon slopes downward. Parabolic SAR sits above the price, indicating resistance. And then I have my linear regression slopes measuring trend and momentum, trading sideways with a downward bias. So sideways on the shorter term, hinting at a lack of clear direction with the momentum, but downward bias on the longer term, meaning that there may be a change in the underlying trend of oil, at least within the limited scope of a 5-day look back. Next, I look at gold. Similar price pattern from a visual inspection of the chart. The asset basically ends the week where it started it, flat on the week, nothing changed. That's also reflected in the linear regression slopes. The shorter slope measuring momentum, oscillating around the zero line for positive to negative. The longer one measuring trend, however, is showing a bit of a downward bias, similar to that in oil. So at best, it's signaling a pause in the upward trend, maybe a consolidation. At worst, the consolidation that can transition into a reversal pattern. Then we have the dollar index, similar to the price action we saw in gold. Started the week at one level, dropped, rebounded, ended the week right at that level where it started. That sideways action that we see in the price is reflected in the indicators. The linear regression curve ribbon oscillating back and forth. Same with the parabolic stop and reverse. No clear sense of direction on the dollar in the short term according to these charts. Similar strategies that benefit from sideways moving markets can be deployed in the currency markets, looking at the dollar versus the majors. That's the dashboard. Overall, no clear sense of direction in most of the markets. The exception being the 10-year Treasury, whose chart is signaling a clear move lower. The rest of the market seems to be in some kind of consolidation or holding pattern. When the entire market or such a broad swath of the market is consolidating, it lets me know from a technical analyst standpoint that there's something happening, there's some shift, some underlying change occurring in markets, and the goal is to be aware of the different instruments, the different markets, and their time frames and their patterns, so that when those shifts start unwinding, and more than likely they're not going to be all at the same time, but when they do start unwinding, you can start firing off your trades as the different markets start unwinding at different times. Next, we'll look at a longer term time frame. Same instruments as the dashboard, just a longer look back, which would allow me to forecast a little bit further out into the future in the forecasting section of the podcast. So the first instrument for the forecast we look at is the 10-year Treasury. And the closest target that pops out immediately is the 50% on a Fibonacci retracement, and this is on a 15-year chart, looking at monthly candles. For reference, last traded on the price of the 10-year Treasury we have 125 and 17/30 seconds. We could probably see the 10-year treasury move down to about 122 and let's call it 13/30 seconds. I'm not 100% sure what the corresponding interest rate would be, but currently the 10-year treasury is yielding around 2% at 125. So take it down to 122. We're looking at probably 2.15 to 2.20, maybe even as far as 2.25. Next, we look at the S&P 500 and looking at a Fibonacci extension. In this case, we see all through 2020 and 21, post-COVID, that the S&P 500 was accelerating higher. Broke through several levels on the Fibonacci extension. Made it to just shy of the 100% level and retraced through the 78.6 level, which was significant. It should have held support. That would have been a good sign. It didn't hold. That level happened to be at 4,300 on the S&P. If that level switched from support to resistance, the next level of support is the 61.8 on the Fibonacci, which would take us down to about 3,800 on the S&P 500. So a little ways to go, but it lines up with the fundamentals of a bear market in both stocks and bonds to see both the S&P and the 10-year treasury on the longer term charts with lower targets. Looking at the longer term charts of crude oil is very interesting because we see that within the recent trading week that oil has gotten to levels that we haven't seen since 2011. A couple more bucks higher and we're looking at all-time highs on crude oil, which in the current market environment with geopolitics or questionable capacity to increase supply of oil from OPEC, along with a lot of the fiscal stimulus that was sent out in response to COVID, consumers are in a position where they can't absorb relatively higher fuel prices compared to 2008, for instance. So with that fundamental difference between now and then, it's plausible that we could see oil prices break above the all-time highs of 147 and go on to the next significant level higher, which would be at 181.10. If there is enough momentum behind the trade, the following significant level or target would be at 201. And I'm not sure how long the global economy could sustain activity with $200 a barrel oil. The picture I see when I look at the 15-year chart of gold is a classic cup and handle pattern. And again, for those technical analysts, those chartists out there, cup and handle patterns usually highlight extensions or moves higher. And as I zoom into smaller time frames on the chart, I see that same pattern repeating itself. So there's a fractal pattern developing, and it presents itself on the smaller time frames, but over time also presents itself on the longer time frames. And I'm looking at a 15-year chart, looking at a chart pattern that's presenting itself. Those series of images on the charts are what have me convinced that gold price can push higher, making new highs above the ones that were made in early 2020 when we first encountered COVID. That idea also falls in line with the idea that in a high inflationary environment, we can see oil prices hitting 180, $200 a barrel, and we can also see gold extending higher to 23, 25, or maybe even as high as $3,000 an ounce. And lastly, we have the dollar. At first glance, I see literally years, 7 years of sideways consolidation, a breakout, and then another, call it 7, 8 years of sideways consolidation. If that pattern repeats, and this is over a 15-year time frame, if that pattern repeats, we're in line for a breakout higher in the price of the dollar, followed by a 7 to 9 year sideways consolidation. So as these charts are presenting themselves at this point, and again, as the markets evolve, the charts evolve, the forecasts evolve, but as the charts are presenting themselves right now on a longer term time frame, they are setting up a picture of falling bond prices, falling stock prices, paired with rising commodity prices, rising energy prices, and also a strengthening dollar. So, the falling bond prices immediately signal rising interest rates, which does mean that the environment that stocks have to exist in is one where discount rates are increasing, so net present values of share prices are falling. Interest rates would have to be raised aggressively in an environment where there is high inflation to fight that high inflation. That kind of environment would be conducive to oil prices skyrocketing higher. In that kind of inflationary environment as well, gold as an inflation hedge would see prices skyrocket, and the rising interest rates would attract international investment capital to the United States via the dollar to capture those rising yields. So the overall picture being painted by the longer term charts sounds like a stagflationary environment. The alternative is the Fed does nothing because interest rates are already low, and by increasing quantitative easing, it would only exacerbate the inflation problem. So even though growth may slow, the Fed may not be able to stimulate through its normal monetary channels. And the federal government on the fiscal side would have a harder time borrowing and spending because interest rates and the cost of borrowing would constantly be rising to stave off the high inflation. So overall, not a very rosy picture, but like I said, markets evolve, economies evolve, the charts evolve, the forecasts evolve. And on that note, we'll wrap it up here. Last week was an interesting week trading. It was a profitable week trading, but it also brought to my attention some macro trends that are underway, particularly in the S&P and the 10-year Treasury. It also gave me the opportunity to take a closer look at the commodity space like gold and oil. And even throughout the week, I took a couple glances at the dollar index as well. Going into next week, similar narrative, therefore similar positioning. Again, still shorting the S&P. No short positions in the 10-year Treasury, but for those of you who do trade those instruments, that's also signaling a short. Gold and oil, and more so oil, seems to be losing some momentum. There was a big spike higher, followed by a rapid reversal. Looking at longer term charts of gold, there's the cup and handle that's forming on the 15-year time frame. Somewhere in the middle, either the 1-year chart or maybe even up to the 5-year chart, there's a bull flag pattern that broke out. And then on the shorter term time frames, granted, there has been a bit of a reversal in the last few trading sessions. The overall trend or the theme that I'm noticing in the gold charts is potential to move higher. Crude oil has a similar profile, but it seems to have a downward bias compared to the upward bias on gold through the consolidation that it's been going through recently. The dollar index doesn't have a clear sense of direction right now. It does seem to have an upward bias, but that's my interpretation from looking at the longer term charts. On the 15-year chart, I see periods of sideways consolidation, and by periods I mean 7 or 8 year long periods, followed by rapid moves higher into consolidation zones, again 7 or 8 years long. Thank you for listening to another episode of IJS Speaks. This has been your neighborhood financial economist, Katie Mark. As always, when in doubt, take profits.